Good evening, everyone, and welcome to the Brian Crombie Radio Hour. My guest tonight is Charles St-Arnaud. He is the chief economist at the Credit Union of Central Alberta. He's been prolific of late talking about inflation, or the lack thereof of inflation, how inflation's come down. And last week he called for a 50 basis point reduction in the Bank of Canada rate, which I think is more than most people were expecting and quicker than a lot of people were expecting. So, Charles St-Arnaud, welcome to the show, sir.
Thank you for having me.
My pleasure. So tell me, what's your assessment? You obviously think that the inflation monster has been slayed, I guess.
Well, when we look at the latest numbers, so we've had the latest CPI number on Tuesday morning, and it shows that inflation in Canada is 1.6%. Just to put some context, because it's always important, the Bank of Canada is aiming to, its main objective is to bring inflation between 1 and 3%, obviously aiming for that mid part of 2%. So at 1.6, we're kind of at the bottom half of their inflation target. And when you look at the kind of a whole spectrum of measures, there's nothing in the report that would be overly concerning on the inflation front.
How has this happened? We've been worried about it for
Well,
such a long time.
Well, the thing is that a lot of what caused inflation or the inflation spike in 2023 or 2022 and 2023 have dissipated. So we've had supply chain issues. Those are less of a problem. If you go to a car dealer and trying to get a new car, you no longer have those 6 months plus delay in terms of delivery. So that's already kind of helping to have having had inventories in many industries and for many goods helps keeping the price in check. Then there was also energy prices have come down quite significantly compared to where they were in 2022, 2023. Sometimes I find the impact of energy prices was underappreciated in Canada because, well, we had at a point where transportation costs were almost double where they were pre-COVID. And in a country as vast and as sparsely populated as Canada, transportation costs matter a lot for businesses. Whether you're in Ontario importing consumer goods from China, well, they need to get to the port of Vancouver and then they need to get transported all the way to Toronto. And those costs cannot be absorbed quickly and had to be passed to consumers. And that has abated. And then obviously there's what the Bank of Canada has done since 2023 is by increasing interest rates. It has reduced the demand side of the economy to reduce some of the excess pressure that we growth. We're seeing the unemployment rate going gradually trending higher, and that's reduced even more inflationary pressures.
I was at a real estate conference recently, and they were suggesting that inflation was actually less than 1% if you took out housing-related costs. Is that true?
It is true, but I think we have to be very careful. I'm very concerned when I see a lot of economists that, oh, if you remove shelter, inflation is really low. It shouldn't be a concern. There's two things there is that one, you can always create a measure of core inflation by removing what you don't like and in the end getting the result that you want. So that's concern number one. Concern number two is that we have to take into account that shelter is about 20% of the basket, and more than 20% of what consumers actually spend on every month, and it's an essential. So by removing that and say, oh, if you remove that, there's no inflationary pressure, it's dangerous because for consumers, that's what's actually driving their inflationary expectations and their perception of where inflation is often shelter and food because that's your biggest item in your budget.
So why then are you calling for a 50 basis point reduction?
Well, that's the thing is that when we look at I always take a more of a broad-based approach, and it's important to look at a vast array of metric when considering inflation, because obviously the inflation rate is just kind of the weighted average of all the components, and it's all nice, but it doesn't give you an idea of where the distribution is. So the Bank of Canada published two what they call core measures of inflation. One is basically kind of the median inflationary pressure. The other one's kind of a different weight on the mean we're removing some of the excess on the mean, and those are now at 2.15%, so very close to target, and has been below that 3% upper band of the inflation target for some months now. So already that kind of signals that, okay, it's not just a couple of factors that are driving inflation lower, it's actually relatively broad-based. Then I look at what I call the breadth of inflationary pressure. So we can look, because there's many components under the in the CPI. So looking at this distribution in terms of how many components are growing above 3%, which is the above the upper band of the inflation target, we're now at about 23%. We were like at more than 50% at the height of inflation. And when we look at components increasing at more than 5%, we're about at 10%. And those ratio are in line when we look at the past history of the past like almost 30 years. When inflation is around target and not a concern, that's kind of this distribution that we're seeing. So that's one part. The second part is also looking at the dynamic in price pressures. Because what we have to to keep in mind is that inflation is the change in price between now and a year ago. It doesn't tell you when those price pressures are. So I like to look at what I call the momentum. So looking at how price have increased over the past 3 months. So if that increase over the past 3 months was to continue for a full year, where we would be in inflation. And that's when we start to look, even on some of the major components, you're seeing a lot of the inflation pressures have been relatively weak. For example, you were talking about housing. Yeah, the housing component year on year is growing at 5%. But when you look at over the past 3 months, it increased by only 3.1%. So it's kind of signals that most of the pressure you're seeing in inflation is from a year ago, not in recent months.
The economist that I heard at a real estate conference recently said that the inflationary component is rent and mortgage interest, but doesn't take into account condo pricing and housing pricing. And given that condo pricing had gone down, that actually there was more deflationary pressures than inflationary pressures. What do you think of that?
Well, that's always a concern. It's one of those things where we have to pick our poison in terms of what do we do in terms of including in CPI. And the thing is, CPI is not perfect. That's something we also have to take into account, is that the measure of CPI is not perfect. It just calculates the price of a good of baskets that the average consumers in Canada would consume. So the real estate prices are not included directly. They're included indirectly. There is on the homeowners side, or the cost of ownership, there's the home ownership replacement cost, as they call it. It kind of includes like cost of renovation, cost of if you had to rebuild your home, how much it would be. So they go more on that side than actually looking at what is the value on the market. There's good and bad on both ways. One is that you might create too much volatility by focusing only on the value on the market. The other part is that you're not necessarily looking exactly, okay, how much people pay when they go and buy a house or a condo. So it's pick and choose. Does it make a massive difference? I don't think so. As long as you understand, and housing is about 20% of the CPI index. So there's a lot of other components that have also a bigger weight. So we have to keep that in mind.
So do you really think we're going to have a 50 basis point reduction this week?
Well, my view is inflationary pressures are not a concern anymore. Like, it's clear in my mind that when you look at the dynamic, when you look at where we'll be with inflation over the next few months, there's no real concern there, in my view. Two is that what we've seen over the past 6 months or so is that we're seeing a Canadian economy where growth has been relatively weak. Actually, I would argue if it was not for the strong population growth that we've had over the past year, actually Canada would be in a recession right now. We've seen the unemployment rate gradually rising. So all those kind of signals that the Canadian economy doesn't need a restrictive monetary policy. We don't need interest rates at 4.25 as they are right now. So, and when you look at how the economy has been absorbing the higher interest rate and adapting to that new regime, it's clear that the health of the labor market has played extremely big role. So we should be careful of putting more restraint on the economy and maybe creating some more issues later on by having layoffs starting to creep up in the labor market. So that's why I'm thinking, let's bring the level of interest rate closer to what I would be considered neutral. So where monetary policy is neither accommodative or neither restrictive, as fast as we can, and then reevaluate: do we need to do more, or it has been enough to kind of start to spur some better activity in the level in the economy.
So 50 basis points this week, reduction in the Bank of Canada rate. Is that your prediction?
That's my prediction. And actually, I would say probably another one in December could be warranted.
Well, a lot of people with short-term interest rates, home equity line of credits, et cetera, would appreciate your conclusion. That's for sure. However, and maybe we'll talk about this after a break. Some people now are talking about that we're actually in a disinflationary environment or risking of a recession, that things have gotten so slow. And you say that on a per capita basis, we may actually be in a recession. So let's take a break for some messages and come back in 2 minutes with Charles St-Arnaud and talk a little bit about whether we've got a risk of the opposite of what we've had for the last couple of years of an inflationary environment, of a deflationary environment, of a recession. Stay with us, everyone. Back in 2 minutes. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. My guest tonight is Charles St-Arnaud. He is an economist. He's a very smart guy. I've had him on my show a few other times. He's always well-versed in what's going on in the economy and provocative with his comments. He's a chief economist at the Credit Union of Central Alberta. Welcome to the show again.
Thank you for having me.
So what about the opposite of an inflationary environment? Could we be in a deflationary environment? Are we at risk of a recession?
In terms of deflation, I think we're still far away. I think we would need a deep recession to get there, but we are probably in a recession, and there are some signs that are pointing to it. One, I would say there's always that sign that, or a lot of commentators pointing that, over the past year, most of the job growth has been in the public sector versus the private sector. That's a sign, a clear sign that there's a very weak economic environment, because usually private sector hiring underperform in recession. The second one is that when you dig slightly deeper in the numbers, you realize that, well, yeah, the economy is still growing, but when we look at let's say GDP per capita, we know has been declining, but when we look at what consumers are doing, when we look at consumer spending per person, they're actually about 3% below where they were pre-pandemic. So we are actually spending less per person, adjusted for inflation. Yet, because the population of Canada still continues to grow, we're actually more consumers. So the overall consumption levels are above where they were pre-pandemic. So as I put it, is that, yeah, we're all tightening our belts individually, but because we're consuming more collectively, and that's what's keeping the economy afloat.
But yet there's, lots of pressure on immigration. It's become, it's the number one issue in the United States right now, but it's becoming more of an issue in Canada. And the federal government has talked about dramatically reducing immigration. So is this issue going to turn around and go the opposite direction and really now cause an even bigger recession?
Yeah, well, that's the one of the concern that we have to take into account, and I'm pretty sure the Bank of Canada is also taking in consideration, is that when we look at the past year, like I said, if it was not for consumption, for the increase in the number of consumer, the Canadian economy would have contracted in late 2023. We would have actually had a recession in 2023 if we didn't have the population growth, or if we had assumed that population would have grown at the same pace as before the pandemic. So that's important to take into account, that population growth is really keeping us afloat. And it's also keeping us afloat in a different way, is that I was talking earlier about the labor market has been relatively resilient. We haven't seen any big layoffs so far. Yes, the unemployment rate is increasing, but it's more a factor that population is growing faster than actually the labor market can absorb those newcomers to the labor market. But the reason why we haven't seen the layoff, even though the condition would kind of normally suggested some layoffs, is that if economic activity is not declining, well, businesses don't need to reduce their headcounts. They're seeing the same amount of sales, the same level of activity. And that's important because over the past year and a half, the fact that we've had a resilient labor market has allowed consumers to absorb the higher interest rates. And we can come back to that. But to come back to what we will see in with population growth, as we know the federal government is changing the objective of is putting a cap on immigration, we'll see population growth slowing. And that we'll start to see all the fragility under the hood starting to creep up. And that's why the Bank of Canada probably should be aggressive now to make sure that the economy is on a more solid footing once the population growth starts to slow. Their estimate is that actually population growth will be about two percentage point lower by the end of 2025, and in 2026. So that will have significant impact on growth for that period.
So is limiting the immigration level a smart move? You know, people had complained about it because of the impact on housing. But at the current time, you know, there appears to be really more risk of a crash in housing. Condos are in a crash scenario, and housing prices for single family dwellings seem to have flattened and are at risk of declining in some parts of Canada, so that housing market isn't going up the way it was. And what you're saying is that the immigration has kept the economy afloat, growing, and therefore kept employment where it is. And so it seems like restricting immigration is dealing with last year's problem. And if we actually restrict it this year, we're going to create a bigger problem for us a year from now.
Well, it's the issue with immigration is that we went too far on the one side, and now we're trying to correcting course. Maybe I'm not sure I would say too quickly, maybe a bit. The issue with immigration is that there's positive and negative. And the way I always see it is that the positive, and that's why immigration has always been seen as positive by most politicians, is that you increase population growth by 1%. The demand side of the economy will grow by 1% because those people are coming here, they will consume, they will have jobs, and that kind of generates some positive economic activity. The issue is that we went too far and too high, and now it's the supply side of the economy that couldn't adjust because, well, yeah, they consume and all that, but the system cannot adapt as quickly. We saw it with create a strong increase in housing costs in major cities. We see it in the pressures on public services and all that, and those cannot adapt as quickly. So I think now we went too far on too much of a good thing and helping the economy. Now we need to let the supply side of the economy to adjust so that we kind of remove some of the friction. It will come at some cost, that's for sure. Housing, it's a bit different in every little city. It's like I'm based in Calgary, and quite frankly, housing is not like lower prices in housing is not something that is concerning us here because prices have been increasing by about 10-15%, and rent actually by 15% over the past year. So it's not in a place like Calgary, for us, it would actually be welcomed if we could see some lower pressure on housing. So, and that's the difference. Each region has its own issues to deal with.
That's because you're getting a migration from Greater Toronto Area, people leaving because of the outrageous housing prices here and moving to Calgary.
Yeah, but also the outrageous housing prices. We need to to keep in mind also that higher immigration was just adding oil to a fire that was already there. We were already talking about unaffordability in Toronto in the early 2010s. So at the same time, I think immigration just exacerbated problems that were already there and probably made it more pressing so that something needed to be done.
So rather than dealing with the base problem, we're just dealing with that last little bit of oil.
Well, the thing about at this point is that housing affordability will be a very hard one to solve because I don't think we're being upfront enough in terms of what it means to solve affordability. To take the case of Toronto, well, that would mean that overnight house prices in Toronto needs to drop by 40% to make them affordable. No homeowner is willing to see that. So, and the other way around is that we would need house prices to stagnate for about 18 years to restore affordability. Again, that's a long time. And even there, I'm not sure many homeowners will be ready to see their house price stay flat for the next 2 decades to restore affordability. So I think there's a bit of that discussion that is not happening often in Canada.
But we're building, what is it, the same number of houses today that we built in 1970 when the population
Yeah,
has doubled in the intervening 50 years?
yeah, that's a big issue, and that's been a big issue for I would say about 15 years or so. The kind of the construction sector kind of peaked in some ways overall in the early 2010s, and since then it has been constantly being much less productive than it was, and it's something that will need to be solved. We'll need to think about that, not just for housing. We have to think about it for other part of the economy because construction is center to a lot of what we need for our future, whether it's well, housing, infrastructures, transportation links, and all that. We've been talking about a productivity crisis in Canada, and construction will have a central a central role in that.
What's the productivity crisis you're talking about?
Well, we were talking about the GDP per capita that was declining in Canada, the fact that actually our productivity, so the amount of each or the amount of GDP that each worker is producing has been going down or not going down, but has been underperforming our peers in other OECD countries. Like we are well below the US like
I
10
heard this
years ago.
statistic that we are now 40% below the United States in productivity versus where we were prior to COVID.
It's about 30%, but yeah, we've been underperforming significantly the US since COVID. But it
What
has
would
been a
cause
lot.
such a massive change between us and the United States that we're 30% less productive than them in the last 5 years?
Well, and the thing is that the last 5 years are probably it's too short of a period to get a good sense. I think we need to look at a much longer period because those trends are just been exacerbated over the past few years because we've brought like the population has increased a lot. We've brought a lot of immigration, and it takes time for newcomers in the country to be as productive as the national. So we have to be careful there if we just focus on that 5 years. But if we focus on the last 30 years, we've been underperforming the US. We've been underperforming Australia, which is probably the country that looks the most like Canada. We've been underperforming Sweden, which is another small economy that relies on exports. We've been underperforming Denmark. We've been underperforming most European countries. So there is something there where we're falling behind. And it's important because productivity is linked to our to wealth creation, to our quality of life, to what we can afford as Canadians. So that's it's a concern is that we're falling behind other countries and basically getting poorer because of it.
So what's gone wrong? What are we doing wrong? I've heard, some people comment that, well, productivity versus the United States isn't fair because they're just willing to work longer hours and take less holidays. But you can't say that about some of the European comparables that you've provided us.
Yeah, or comparing to Australia, because sometimes you can always say, "Oh, it's because we're maybe more resource oriented, we put and things like that, or we're a small open economy, which we're price takers." But Australia has been performing better than us. I think there's many issues there like that we can talk about. Like we can talk about more regulation in recent years. It takes longer to build things, takes longer. We could be also less willingness to take risk in Canada. One of the things that has been often put in place or put forward, and we see it, is that in general, Canada spend a smaller share of its GDP towards productive investment. To give you an idea, and I wrote on that last spring, as a share of GDP, Canadians spend more on housing renovation and home ownership transfer cost. So basically flipping homes or just exchanging houses. Then we spend on machinery, equipment, and intellectual property. And the result is that we've been seeing over the past 30 years, the share of investment in productive investment has been declining. The share of investment in less productive has been increasing.
But the
And part of it
challenging
is,
thing about that statistic is that we're not doing it in investing in more homes, just more expensive homes.
yeah, that's the thing. That's the thing. We're just spending more on exchanging homes, which is not productive. So and that's what I wrote, and then on purpose is basically Canada's obsession on housing is cannibalizing productivity,
Say that
and we
again.
are
Our
seeing that
obsession with housing is
with
cannibalizing.
housing is cannibalizing productivity.
Really? That's
And
fascinating.
the issue is that, and we see it in the data. If we look at lending to households have been increasing as a share of total lending since the 80s, at the expense of the share of lending to businesses has been declining. So and in some ways, the way the financial regulations are made is that there's an advantage for financial institutions to, it's less risky for them to lend for a residential mortgage than for a small business. So, and that's some of the consequences. We've had the past 30 years, our whole growth model in Canada and many industrialized economy has been households borrowing more and more, spending more and more, buying more and more expensive homes, and at the expense of business investment that has been declining as a share of the economy.
So what do we got to do? Actually, let's take a break for some messages and come back in 2 minutes. I'm going to ask Charles, what do we got to do? This has got to be the issue of today. Stay with us, everyone. Back in 2 minutes.
Yeah.
Welcome back, everyone, to the Brian Crombie Radio Hour. Really interesting conversation with Charles St-Arnaud, chief economist for it's the Credit Union of Alberta.
Yeah, it's called Alberta Central. We provide all the central service for all the kind of central bank first services for the credit unions in Alberta.
And you've had experience right across Canada, is that not correct?
Actually, yeah, mainly in Canada, mainly in Ottawa, both at the Bank of Canada and the Department of Finance. But I've done most of my career outside of Canada in London, England, and New York City.
So you're an internationalist.
Yeah, we can call it that way.
What's gone wrong? You've had experience in New York, you've had experience in London, you've had experience across Canada, you've had experience in the Bank of Canada and the Department of Finance, Ministry of Finance, and you're now in the center of our resource industry in Alberta. We've got so much going for us. What's gone wrong in Canada?
Well, I think it's a combination of different things. Is that one is, as we were talking earlier, I think the growth model that Canada had chosen in the 90s and 2000s, where everything was for everything was based on the consumers, has led to issues that we are now coming to haunt us. Is that we haven't been investing enough in our in the productive sector of the economy. We have a housing sector or a household sector that has been borrowing excessively over the past 20, 30 years to a point where it is actually a big vulnerability to our economy. We have housing issues, a part of that, but part also that we haven't been investing. We have too much regulation and all that prevent the adjustments that are needed. So there's a lot of things that are, it's kind of, we're kind of going at a point where all our issues of the past few decades that have been accumulating are now all pointing in the same, or are all coming to create their own problems now.
What do you think the solution is?
Oh,
if I appointed you Minister of Finance, or
yeah,
Governor of the Bank of Canada, or Prime Minister of Canada, what would you do?
we need to think hard about what we want to do. One of the thing is, and like we were talking earlier, that like household borrowing has been crowding out businesses over the past 30 years. To give a quick stat, households in Canada have been borrowing for the equivalent of 4% of GDP every single year since the late 90s. That's a lot of resources that are not available for other sector of the economy. If we go back to the 70s, households were actually mostly savers. They were not big borrowers, and that provided savings that could go in investment. Because it's important to there's I call it kind of an essential equation in the national account, is that savings equal investment. So someone to invest, someone needs to save. That saving can be domestic or foreign, but you need that critical mass of saving, and we'll need tons of investment over the next decade to solve whether it's affordability, whether it's productivity, whether it's climate change and adaptation and energy transition, whether it's also all our military expenses. We need to start building our capacity to meet our engagement on NATO, but also if we want to be serious about our Arctic sovereignty. All that will cost money. So we need that savings at some point. Unfortunately, the only sector that can save and provide that money is the household sector. Not sure, though, it will be popular for a government to say that, oh, households, you've been consuming a lot, borrowing a lot. Well, the party is over.
But
That's
yet
not going to be
you're
popular.
arguing to reduce the interest rates. If the interest rates go down, aren't people going to have this huge incentive to start borrowing again?
I think that we need to be careful is that lower interest rates is more of a short-term solution in terms of we're higher than neutral, so we don't need restrictive monetary policy. What I'm not arguing is that we shouldn't go back to the rock bottom interest rate that we had pre-pandemic. One thing that's for clear in my mind is that we will have higher interest rates in the future than we've had in the decade between the financial crisis of 2008 and the pandemic of 2020. Our interest rates will be probably maybe almost double that period.
I was at a conference recently, and one of the economists on stage said the biggest risk to the Canadian economy is the 20% tariffs that former President Trump is arguing he's going to put in place on day one if he becomes president again. What do you think the impact of 20% tariffs against all international goods would be on Canada?
Yeah, that question there is how much of it will be applied to Canada, considering we have the USMCA or free trade agreement. But if we were to say, okay, at 20% on every goods, that will start to be really hurtful for Canada. We have to remember that 3/4 or plus of our exports are going to the US. The question is on what it will be applied. A big share of our most valuable exports to the US is actually our oil industry. Are they willing to tax that and kind of hurt themselves at the pump and hurt their own consumers at the pump? That will be a question I would leave for politicians down south, but I don't think that would be popular. So I think it will be mainly on manufacturing goods. The idea on their side is that they really see that over the past 30 years, a lot of their manufacturing capacity has left completely the continent, not just the US. A lot of it has been moved to China. Now it's coming back to, and they want to come back to the US, but it's mainly going to Mexico right now.
And so what's the impact of this? Is that it will be harmful to Southern Ontario and to Mexico, but not to Alberta?
Well, that's the question. Is that as you have to put yourself in the shoes of US politicians. I don't think they will want to put tariffs on import of energy at the risk of hurting their own economy. So I think there might well be some regional differences where the manufacturing heartland of Canada, so Ontario and Quebec, will be probably the most negatively impacted compared to the energy sector here in Alberta.
Tell me about what you think about currency exchange rates. Some people are suggesting that Canada can't have an independent monetary policy, and you're calling for a 50 basis point reduction in the Bank of Canada rate. Mm-hmm. Some people are worried that you can't do that because it'll lead to a depreciation of the Canadian dollar, and all we'll do is import inflation from the United States because of a higher US dollar.
Yeah. Well, I'll put my other cap that I've had for almost 10 years as a foreign exchange strategist on Wall Street and the city of London is we need to be careful with that. Yes, the level, the difference in in the interest rate matters for the exchange rate, but it's not necessarily what happened. Is the expectations matters even more. The cuts at the Bank of Canada are actually almost fully priced in. Right now, last time I checked earlier this week, there was about I think the market is expecting the Bank of Canada rate to reach 275 by the summer of 2025. So there is a lot of already cuts that are priced in Canada. So would front loading some of those cuts change much? It will be very marginal in terms of impact on the exchange rate. I think, and we saw it in over the past 2 months. Change in expectations for interest rates at the Federal Reserve have had a much bigger impact on our Canadian dollar than what the Bank of Canada has been saying. We saw it when expectations of a 50 basis points cut at the Federal Reserve started to creep in. We had a big appreciation of the Canadian dollar, and now with data in the US being stronger than expected and kind of reducing the likelihood of fast cuts on their side, that's when we started to see the Canadian dollar depreciate. So it's not the Canadian side of the equation that's actually driving the exchange rate at the moment.
So you're thinking that number one, the Bank of Canada is going to reduce the short-term rate, the Bank of Canada rate by 50 basis points. You think inflation has been reasonably brought under control. You think that immigration is going to come down and that we're ex-inflation in a recessionary environment, and that bringing immigration down may cause some additional problems from a recessionary standpoint in the future, because that's going to take away some demand in the economy. You think that the housing sector has been cannibalizing investment in productive parts of the economy. You don't think we invest enough in research and development and manufacturing and productivity, and we invest too much in housing. You think our government employment, our public sector employment has been increasing way too much, and that is an example of what's gone wrong with our economy. You think our productivity versus not just the United States, but Australia, and you mentioned about 4 different European countries, has been declining relative to our peers for 30 years, not just the 5 or 10 that I quoted. Things aren't looking very good.
Yeah. And that's the thing is that, and that's what I'm saying, is that it's a confluence of challenges and issues that have been left unchecked in Canada for the past 20, 30 years because they were not popular.
So in the 1980s, there was a Royal Macdonald Commission on the economy. 26 volumes were written. The Royal Commission traveled across the country, interviewed a whole bunch of smart people like yourself, and came forward with, I think several radical recommendations, but 2 that are most noteworthy is to change our taxation system to put in a value-added tax, which ultimately a couple of years later ended up with the GST, and to enter into a free trade agreement with the United States. In 1988, we fought an election over that. In the 1990s, Canada was described as having a Canadian peso crisis, and our Canadian dollar was depreciating fairly dramatically. And Jean Chrétien, the Prime Minister at the time, and Paul Martin, the Minister of Finance, went through a massive reduction of federal spending, such that by the end of the 90s, we actually were in surplus, which today is like shocking to believe that we actually had a surplus in the Canadian budget back just 20 years ago. What, if anything, could we do today that would be anywhere close to either that massive reduction in spending in the 90s or the free trade agreement or the GST that was entered into in 88 and 91?
That's a good question. And actually, it's an interesting question because I was at a conference this week here in Calgary, organized by the University of Calgary School of Public Policy, on actually productivity, and brought a lot of bright minds from across Canada to discuss it for 2 days. And it's interesting because there's a lot of various part. One of the part is this regulation. It takes way too long to get anything done in this country compared to where it was just in the early 2090s. So we need to think about how can we accelerate decision making and starting to invest in our economy much faster. There's issues in terms of, like I explained, is we need a lot of investment in this country over the next 10 years. And there's not enough discussion in terms of how is it going to be financed? Because yeah, I always hear, well, we'll just borrow to foreigners. Yeah, but foreigners are not just going to lend to Canadians because we're nice and smiley and polite. They will ask for return. So we need to think about that too, is that our cost of borrowing might go high, will go higher if we start to borrow too much. Even if it's not the government, private or anything, if there's one thing is that there's a big competition for investment around the world. So and it's that, and I'm not hearing enough of that discussion. But the problem is I don't think the general public understand what productivity is and what's in it for the average person or for the average Canadian. There's not enough. I don't know if it's not enough an education or an understanding that higher productivity doesn't mean that you're working harder. It means that actually you're working smarter. So for the same amount of hours you're working right now, you actually can produce more and make more money. That's what needs to be put in, and you need that general public support to solve it. Because at the end of the day, I always say as an economist, you can have the best policy in place, but if it's not good politics, it's not going to be put in place by any political party.
Do you see our political parties addressing this issue? You know, we seem to be infighting about, foreign interference in elections, about carbon taxes, about things that are at the margin, it would appear to me, rather than this fundamental issue of Canadian productivity and investment.
Well, that's the problem we have. And it's part of the issue that we've had over the past decades is that we're never like we're talking about housing affordability earlier. We've known there's been an affordability crisis in Toronto and Vancouver for decades, but nothing has been really done. And that's the thing is that until it becomes a consensus, and I think that was important in the 90s when we were slashing the deficits quite aggressively, is that there was a strong consensus in the political sphere, but also in the general Canadian public that that was the right thing to do. So until there is more support or more understanding at the population level of why it matters to really push productivity, it will be very hard for politicians to go down that route.
In these other countries that you mentioned, the United States and the 4 or 5 European countries and Australia that you used as the peers that have had better productivity, what's been different there? How have they sold the populations on increasing productivity?
Yeah, well, I think I will talk about Australia first because I used to cover Australia as an economist, so I know it a bit more. And there's always and it's a good parallel because I always find Australia is like Canada, just different resources and different location on the globe. But the institutions are very similar, so it's really a good comparison. Is that in their side is that they realize in the 90s that they were falling behind in the 80s and all that, and they had trouble competing internationally, and they had put in place what they call a productivity commission. So where a lot of specialists would, like, they started in the 90s, so they had what can be done, and it's a recurrent report. They look at their economy and say, okay, what can be done? So we almost need some more of those discussion, making sure that there are more discussion in terms of what can be done, and making sure also that the political side of the equation is willing to look at those recommendations and implement those recommendations. So I think in Australia that has helped them is that they've had that. It's time for a national discussion on that.
Time for another McDonald's
because we're talking about decline. Yeah, something maybe similar, because it's time for the general public to understand that without productivity, our GDP per capita will continue to underperform, and that means that we'll get poorer versus other countries in the world.
Charles, thank you so much for joining us. I really appreciate it.
Thank you for having me.
If people want to follow your posts, what's the easiest and best way to do that? Follow you on LinkedIn or Twitter or what?
They can follow me on LinkedIn. They could go on our website, albertacentral.com, and go to the Intelligence Center where we publish all our research. There's a link to subscribe to my mailing list.
Charles St-Arnaud, I really appreciate it. Thank you so much.
Thank you.
We're going to take a final break and come back with some concluding comments in just 2 minutes. Stay with us, everybody. Thanks, Charles.